Starting to invest online with just $100 can be overwhelming, but it's definitely possible, and many people ask me how to do it. For years ago, I set out to answer this question by investing $100 into 5 different investment options. Today, we'll compare those investments and see how they performed over the last 4 years. We'll judge them on the following categories: learning curve, how easy it is to understand each investment type; passive income potential, how much income you can earn passively while holding the investment; tax efficiency, how well the investment allows you to save on taxes; risk level, the likelihood of losing money; results, how much the $100 investment is now worth. 1. Individual stocks. Individual stocks allow you to own a piece of a company you believe in. This can be exciting because you're directly investing in businesses that could grow or succeed. Learning curve, high. You need to understand the company's financials, leadership, and the industry it operates in. It involves deep research into balance sheets, income statements, and more. Passive income potential, good. Stocks can pay dividends, which is a form of passive income. Not all stocks pay dividends, but those that do give you money without selling the stock. Tax efficiency, great. If you invest in the right accounts, like a stocks and shares ISA or a Roth IRA, you can reduce your tax burden significantly. Risk level, high. Stocks can be highly volatile, and you can lose a significant portion of your investment if the companies you choose fail. Results, my $100 investment in individual stocks is now worth $67.72. This resulted in a negative return of minus 32.3%. However, individual stocks can do much better if chosen wisely, like Apple, Microsoft, or Nvidia. 2. Real estate investment trusts, REITs. A REIT allows you to invest in property without buying physical real estate. REITs pool money from many investors to buy, manage, and lease properties, then share the rental income. Learning curve, moderate. While easier than buying physical property, you still need to understand how REITs operate and the types of properties they invest in. Passive income potential, great. REITs are known for paying high dividends because they must distribute 90% of their income to shareholders. Tax efficiency, great. In many countries, you can hold REITs in tax-advantaged accounts, like a stocks and shares ISA, which can help reduce your tax burden. Risk level, medium. REITs are less risky than investing in a single property, as they often own multiple properties. However, they can still be impacted by downturns in the real estate market. Results, my $100 investment in a REIT is now worth $98.59, resulting in a small loss of minus 1.41%. However, dividends added $1.93, bringing the total return to plus 10.52%. 3. Cryptocurrency. Cryptocurrency is a digital form of money not controlled by any government. Examples include Bitcoin and Ethereum, which run on blockchain technology. Learning curve, moderate. To get started, you'll need to understand wallets, exchanges, and how the supply-demand of coins works. Passive income potential, moderate. While cryptocurrencies don't pay dividends, you can earn passive income through staking, locking up your crypto to help process transactions, or yield farming, lending out your crypto. Tax efficiency, poor. Many countries tax cryptocurrencies as capital gains, and staking rewards are taxed as income. Additionally, you can't hold crypto in tax-advantaged accounts. Risk level, very high. Cryptocurrencies are extremely volatile, with prices swinging wildly. While some people have made massive profits, others have lost everything. Result, my $100 investment in Bitcoin is now worth $652.124, showing a return of plus 552.12%. However, this kind of growth is rare, and most cryptocurrencies don't perform like Bitcoin. 4. Gold. Gold has been a trusted store of wealth for thousands of years, often called a safe haven during times of economic uncertainty. Learning curve, low. Investing in gold is relatively simple, whether through physical gold, bars, coins, or gold ETFs, funds that invest in gold. Passive income potential, none. Gold doesn't generate passive income or dividends, it's simply a store of value. Tax efficiency, good. In some countries, like the UK, you may not have to pay capital gains tax on certain gold coins. Gold ETFs can be held in tax-advantaged accounts, like stocks and shares ISAs. Risk level, medium. Gold is considered a stable asset, but it doesn't grow as fast as stocks or crypto. It's mainly useful for preserving wealth. Results: my $100 investment in gold is now worth $140.110, showing a return of plus 40.1%. While this is solid, it's not as exciting as the performance of stocks or crypto. 5. Index funds. Index funds allow you to invest in a basket of stocks that track an index, like the S&P 500, giving you exposure to a wide range of companies. Learning curve, low. Unlike individual stocks, index funds are passive investments, meaning you don't have to pick individual stocks. Passive income potential, moderate. While index funds don't pay high dividends like REITs, many of the companies within the index fund pay dividends, which are either distributed to you or reinvested. Tax efficiency, great. If you hold index funds in tax-advantaged accounts, like a stocks and shares ISA or a Roth IRA, you don't have to pay taxes on dividends or capital gains. Risk level, low. Index funds are diversified across many companies, reducing the risk of loss compared to individual stocks. Results: my $100 investment in an index fund is now worth $179.536, showing a return of plus 79.53%. This solid, steady growth shows why index funds are a great long-term investment option.